Guys, let's just summarize where we are, what we're doing. So, the book in hand looked at what is income, some exclusions from income. We've looked at computing gains and losses. We've looked at the character of that income. We've looked at to whom it gets taxed. And we spent several classes discussing expenses, right? And we looked at our three baskets, section 162, 63, and 262 expenses. All right, and we spent quite a bit of time discussing deductibility issues, educational expenses. We saw how 162 is tied to peanut butter and jelly. Code section, James, is 162.
That's personal expenses?
No, I mean, what puts limitations on code section 162? David, you're holding up or holding out?
74?
274, right? 74, right? 274N, 274M, all 274C. All those say, hey, even if you have a legitimate deduction, it may be curtailed, right? And we also, just advance warning, code section 212, which deals with investment expenses, likewise limited, right? In some instances by code section 274. And then I just want to make sure, again, because you're going to see this on the exam, depreciation. You need to know some central things to, it's very mechanical, nothing earth-shattering. I will supply, for exam purposes, the class life. Once you know the class life, you'll know the recovery period. So most common depreciation method, Jiang, is what? Double declining, right? Double declining, right? And addition, Justin, name the potential conventions.
Conventions are the half-year convention, mid-month, mid-quarter, and full month.
Right, so just because you're going to mentally know this, when do you apply each, Justin?
So the half-year is the most popular. It's for tangible property.
Right.
The mid-month is for real estate, or like real property.
Buildings.
Buildings. Mid-quarter convention is if more than, I believe it's 40% of the asset was put into.
Assets, plural.
Assets were put into
Service.
service at the end of the year.
Last
Last quarter, I should say. And then for the full month, I don't remember that one. Oh wait, I think it's full month is for intangibles, right?
Okay, so we have our convention, we have our method. What else do we need to know, David? Duca?
Oh, the recovery period, isn't that?
Recovery period, right? It's based in part on the class life. We also have the alternative depreciation system under 168G. That uses class life as opposed to the recovery period. And so in the sharp decision that sometimes courts and taxpayers should bifurcate assets between personal assets and business assets. We also saw sometimes Congress is very generous. Why is Congress generous? It gives us accelerated depreciation deduction, right? Oh yeah. You recall what code section? Say again? 168K, right? Which permits what? Immediate expensing, right? 168K, and by the way, again, very unique. For the first time, it's both used and new equipment where you can get accelerated depreciation in many, many years. It's only been new equipment. Why? And when we say new equipment, what kind of assets are you referring to? Just make sure we're all on the lingo, James.
One that's never.
So what kind of property is it referring to?
1231.
1231. And James, when you say 1231, what code sections immediately come to mind?
1245. 1250.
1250. Everyone got that on WebEx? 1245 and 1250, right? You're not. So 1245 and 1250, I like the way your brain connects things. And that's a good thing because and you guys have to know this both inside and outside the classroom, right? And on the CPA exam. All right, so we have those various code sections. We have depreciation methods. We have Congress giving us 168K. Good news, 179 as well, bonus depreciation. And we have limitations too, code section 280F, right? For so-called listed property and for our purposes, automobiles, where there's a restriction on the amount of deductibility. On depreciation, any questions you guys have? That is everyone comfortable if I give them a piece of property, you can depreciate it and give me the correct answer? Any issues, concerns, or the like? You guys are good?
So,
Ask more than one question.
so can you explain a little bit about like luxury automobiles? Like, can we just deduct any cars or?
No, you can't. Code section 280F, capital letter F.
I know, but like, what is like the luxury automobile? Any automobiles that exceed?
Luxury automobile, the word luxury is a misnomer. It depends on what your first year depreciation is. Second year, third year, if you get a Hyundai, for example, you're not going to be able to take 168K and expense the entire Hyundai. Let's just say a Hyundai is 25,000. Okay, you're going to be capped, and I don't have the number in front of me, but the first year I believe is something like 18,750. Do you guys have that number? We did an example in the class.
10,000 for the first taxable year.
Yeah, no, that's 10,000 plus whatever is in 280F. So do you have that number? 10,000 plus that number.
Of the depreciation deduction for any taxable year for any passenger or automobile shall not exceed 10,000 for the first taxable year in the recovery period.
Yeah, but if you look at 10,000 plus, I apologize. Let's see if I can find this quickly. If not, I can send you an email with it. 168K, in addition to the 10,000, they give you even more than that 10,000. But the first year, if you look at code section 168K, let me get the number for you. A2F, capital letter F. It increases by 8,000. So the first year is 18,000. See that? Capital letter F.
Oh, so it's 18K first year, right?
That's the maximum. Now, if you
Okay.
buy a Hyundai, for 25,000, guys, and you put it into service, say, I'm going to make this up. I don't want to make it. You put it into service, say, March 1st, 25,000. What's your depreciation the first year?
18,000.
Remember, this is a cap of the most you could take. But what's the normal depreciation for a car? Just give me a number. Let's just assume, but for luxury automobiles, okay, code section 168K does not apply. Just give me a number, $25,000 of property placed into service March 1st. What would be your depreciation deduction, guys? How much would it be? use your normal depreciation rules. How much could you depreciate? What's the useful life of a car? 5 years, right?
Yeah, right.
5 and recovery period is 5 years. So what would be your allowable depreciation in year one? Okay, how did you get that, James? 5 year. It's 5 year recovery period. What happened to the half-year convention?
That by half. 5,000.
Would be. James, did you not apply the half-year convention? But hold on, but you can't, guys, for my mental sanity, on an exam, that's not good news for you or me if you don't apply the half-year convention, right? In this particular instance. Do not, please, I implore you, not forget to apply the convention. Because you're going to lose lots of points. You're going to be frustrated. I'm going to be frustrated. And that's not good for anyone, right?
Always apply that unless you purchased it like on
You
January
always
1st.
apply a convention.
What if you bought it on January 1?
Apply the half-year convention. Your question to me is, suppose you buy it on December 31st.
Okay, you get to apply the.
What would you do, Justin? If that's the only property you placed in service that year, you'd be forced to use mid-quarter convention. What would be your numerator and denominator?
5/12.
Would that be, Maduka? 1.5. You have only 1 day left. You're going to give them 75% of their depreciation, or you're going to give them a very little number. James, you got that?
Yeah.
It would be 1.5 over total. So, guys, the year you put property into service, make sure you apply your conventions. The final year, you got to apply a convention as well, whether it be sold or it's the last year of depreciation. But if you don't apply the convention, you're already starting with 2 hands tied behind your back for the exam and the CPA exam as well. Not going to be good either. And then we began a discussion in Chapter 15. Chapter 15, we learned originally Congress, there was no Code Section 212, and the Higgins case exemplifies that because the taxpayer was precluded from taking any deductions for investment-related expenses. Congress doesn't like the outcome of that case and says, hey, you want to spend money to make money, you're going to get deductions. So Congress does permit taxpayers to take a deduction under 212. But then we learned in Bowers v. Lumpkin that Code Section 212, just like Code Section 162, limitations with respect to capitalization, right? Certain expenses have to be capitalized. So if you pay money to secure an asset, you can't deduct that immediately under 212. It has to be added to the basis of that asset. Kratzky v. United States. Dealt with a case of what does the word speculative mean, or proximate cause or proximate relationship, and held in the taxpayer's favor. That was a proximate relationship. And Fleischman v. Commissioner examined in the divorce context what expenses might hit the preservation or conservation of property. And we looked at the so-called origin of the claim case. Why was this case being brought? The Gilmore case, the origin of the claim case is, hey, was this case, the Fleischman case, was it brought because the taxpayer sought to preserve his, or in this case, his assets? Or was the case brought because this is a marriage that was coming apart? And it's certainly the latter, right? So the expenditures here reflected what kind of expenditures, guys? Up today is to finish chapter 15. Problem. We will then move on to discuss the important issue of timing. In today's class, we'll see how far we get with respect to the so-called cash method. And Wednesday's class will be the accrual method. And Monday, we'll finish up whatever remains, and then any questions you guys have, I'll be available. There's a discussion beginning on page 455 of the forming commissioner. Here, a taxpayer received a devise from his mother. When you hear the word devise, we think of, right? You guys are experts now. Two code sections, 102, which says, hey, no income. Code section 1014, basis equal to fair market value rule. And they got this property, they moved in, and then they decided to move out. Okay, so they moved in, they thought it was too large and expensive, and they're going to try to rent it out. Okay, we're going to try to rent it out. And the questions, there's three questions the court has to address. Can they get deductions for depreciation under Code Section 168? And they get maintenance and conservation expenses under Code Section 212. And can they take a loss on the property under Code Section 165? Now, bear in mind, this case, the fact pattern predates the 1954 code. So if you see references to Code Section 23, it's not a typo, just that you guys, by this stage, know that some of the cases are going to refer to code sections that are obsolete, but that's okay. If you look on page 456, the first full paragraph, the threshold in italics for depreciation deductions is the property has to be held for the production of income. Held for the production of income. And that's a fairly low threshold. And the court was willing, hey, you try to rent out that property, doesn't mean you actually have to rent it out, but you sincerely try to rent it out, you can take depreciation deductions. So, court allowed depreciation deductions. Likewise, for maintenance and conservation expenses, it's a fairly low threshold. It has to be held for the production of income. Okay, for the production of income. Insofar as losses are concerned, under Code Section 165, the threshold is higher. The italics language on page 457, when I say italics language on page 457, this is straight from the code. Okay, so the judge is not just coming up with this language, him or herself. This is straight from the Internal Revenue Code. The transaction, if you recall, under 165, has to be, the transaction has to be entered into for profit. The only way you can take a loss is a transaction entered into for profit. And 3 or 4 lines down, or towards the end of that paragraph on page 457, the judge says, when property has been used as a personal residence, in order to convert the transaction into one entered into for profit, the owner must do more than abandon the property and list it for sale or rent. This is a higher threshold. It was sufficient under the other 2 thresholds simply to rent the property. Here, something more is necessary, and that something more was not met, so the taxpayer here was precluded taking a deduction. Included. So 2 out of 3 ain't bad, but the taxpayer did not get the loss. Okay, that loss was disallowed. Any questions? Anyone on WebEx have any questions? This or anything logistically? Lori, you want to look at the next case? Lori v. United States. This is a fun case. Interesting case. Anyone have a chance to read it? Want to talk about it? I want to, again, the podium. Justin, you want to for it? Right. So you get to hear more of my monologue. I should start because placement is important here. This case involves property held in Martha's Vineyard. So anyone on WebEx or anyone in the room, anyone been to Martha's Vineyard in this room? Sorry, you and I. Anyone on WebEx been to Martha's Vineyard? We're going to type in.
You got to hit the
You have
chat
to
button.
click the thing.
I have to hit the chat.
Yes.
They can't. Oh, Max is saying yes. All right, Max. So, Natalia, how's it in the vineyard?
Very nice.
Very nice, right? Is this for the hoi polloi or is this for the upper crust? The cheaper,
Oh,
expensive. Speaking of the Kennedys, right? Right, James?
I was going to say it, but.
All right. The Martha's Vineyard is for the well-heeled, right? It is not cheap property. Although, personally, I am not into what I will refer to as eye candy. I don't know about you guys. It is really beautiful, but at least for my body temperament, I cannot deal with ice cold water. So here you are surrounded by beautiful ocean, but unless you guys have stronger stamina than I do, you guys ever get into the water north of Boston and north? Way too cold for my blood. And anyone here ever go swimming in the Pacific? That too is a lot of eye candy. Irvine, you've been? Wear a bodysuit or you just go? Both?
He's built like a rock. He could take that.
Just for training.
Yeah.
What was that? Just
Training.
raining? It's cold. Because I like it down. If you guys have ever been to Costa Rica, I like that kind of ocean water. My temperature. So Max, you go swimming down in the vineyard or up in the vineyard? Oh, you can hear me, Max, or you're... Anyway.
Stop, Max.
All right. So in the Laurie decision, what happens here, guys? Guy owns an expensive, I'll assume it's an expensive piece of real estate, and he wants to sell it. But in the meantime, he incurs certain maintenance expenses because he puts it up for sale, but notwithstanding that he put it up for sale, it took several years to actually sell the property, okay? It took several years to sell the property. And during those intervening years, he wants to expense, someone's got to groom the lawn, someone's got to, keep the place clean. He incurs a lot of expenses and he wants to deduct those expenses. Just to give you an idea of who we're dealing with here, I always find this sentence amazing. On page 460, this is the carryover paragraph from page 459. If you go 4 or 5 lines, I should say it the other way around. So on page 460, if you go 6 lines down, 6 or 7 lines down, as evidence of his intent to treat the vineyard property as a business asset, plaintiff testified, the plaintiff is the taxpayer, that in 1971, his daughter, after returning from abroad, requested to use the property. Plaintiff refused, stating that the property was a business proposition. As a fatherly gesture, however, he rented a summer home in Maine for her use.
Right, guy.
So I would imagine that many of you, if your parents said, look, summer home we can't use this summer, might rent a house on your behalf as well, but who knows? But the bottom line is, picture if you will, he going to try to sell the property, but he is not going to rent the property, okay? That's pivotal here, okay? In contrast to the case we just looked at, he is not going to try to rent the property. And if you saw from the last case, renting the property was an important, even though they didn't rent the property in the prior case, actually trying to rent the property was an important attribute of showing an intent to make profit. The tax court ruled against the taxpayer. if you go to the last paragraph on the bottom of page 460, tax court in attempting to establish a clear guideline. Clear guidelines, generally guys are good guidelines, right? Clear guidelines are good ones. In a murky area, it created a simple test. The taxpayer had to make a bona fide offer to rent in order to convert residential property into income producing property. Right? I'll buy into that, right? That would create a clear test. But instead, this court is going to not use that clear test. This court instead, if you look at the bottom of page 460, under the so-called Newcomb case, at the very bottom of page 460, the last sentence that continues on to page 462 says, the critical inquiry is, therefore, whether the taxpayer had or intended a quote-unquote expectation of profit. So that's going to be the benchmark here to determine whether or not these expenses should be deductible, whether or not there was an expectation of profit. And there's going to be multiple factors to use. Reminds me of when you were trying to determine what's a reasonable salary. Multi-factor tests are always, by their nature, murky tests. So, report on page 462 says we're going to use this multi-factor test to determine, in lieu of just seeing if the taxpayer rented property. And what does the court conclude? The court concluded that the taxpayer truly sought, after they decided not to use the home as a personal residence, they decided that they were going to try to make money from the post-depreciation, that they would just hold the property as an investment, and that they put the house up to the market in 1965, that it was going to go up in value over the course of the intervening years, and therefore they should be entitled to a deduction. But most people who decide that they're not going to use something for personal use and convert it to investment use don't put it up for immediate sale, right? Because the fact you put it up for immediate sale contravenes the notion that you're going to hold on to this and let it appreciate in your hands, right? Everyone agrees that normally when you make an investment, the approach is, hey, let me hold on to this because I think for reasons A, B, and C, it's going to significantly appreciate in value in my hands. I don't want to sell it today because if I do, I'm not going to get that rise. Here, the court, in my opinion, drank the Kool-Aid. Look on page 463, the paragraph that begins the fact. The fact that plaintiff immediately listed the property does not negate his contention that he intended to capitalize on post-abandonment appreciation in land values. By an immediate listing, plaintiff made the property a visible commodity on the demanding market. He patiently waited until the economic forces pushed the market value of his property up to his list price. Call me cynical. I've been called worse, I'm sure. And by the way, the Star-Ledger apparently on Thursday or Friday published op-ed contravening my piece. So if you want some more entertainment, go for it. So call me wrong on this as well, but I'm going to be cynical that this judge, district court judge, and our taxpayer, I think, spent many a summer at Martha's Vineyard together. I don't know if I would have ruled this way, guys. I mean, this looked pretty hokey, in my opinion. This is pushing it. So, yes, the taxpayer does prevail, but to me, this decision is somewhat suspect. Go ahead, James.
Just because I need it, thrown in my face. The whole point of this case is that people want it to be an income property because so that they can take the deductions if it were residential.
No deduction. Okay? You cannot, if you pay, James, you have a house and you pay someone to cut your lawn, you can't deduct it. But if it's investment property and someone cuts the lawn and maintains the grounds, you can deduct
From personal income?
Well, it's your investment income. You're holding on to that property like a Schedule C kind of investment. You're holding on to that property with the aspirations that it's going to increase in value. All right, so beginning on page 464, that's the case. It's not it's not like Crane or Lucas Bureau or Wells v. Halvering. This case is not going to be one of those named cases you can cite at the water cooler. Maybe forewarned. The authors give a note towards the end of the chapter about Code Section 121. As you guys know, placement in the code is important. That placement in the code, recall that there's certain code sections I pointed out to, Code Section 101, 102, 103, 104, 105. All those code sections deal with exclusions from income, right? Well, Code Section 121 is something that you or your parents may be familiar with, or grandparents, is that Code Section 121 exempts the first $250,000 of gain when taxpayers sell their homes. And if you're married, it's $500,000. Just from a policy perspective, why do you think it's in the code, guys? Why do you think Congress was so magnanimous about having this in the code? James.
They want constituents to like them.
I mean, you can make constituents like you by exempting capital stock gains. Why this one? I mean, of course, all politicians, you would think, would want to exclude as much income as possible because by excluding income, will like you. But, we have to balance the budget as well.
Keep the scope of it. This impacts more people than.
What factor would you cite to that makes gains on houses hard to measure? Anything that makes gains on houses hard to measure? Look, by the way, there's a cultural reason, James, you might say, is that just like everyone has to or used to like baseball, right? Who's American? Live in this country, you got to like baseball and football, right? Maybe not so much anymore, but in yesteryear, that was a sine qua non. I tested whether or not you were the American. Similarly, when it comes to homes, home ownership, right? Well, it's sort of like for politicians, we're promoting home ownership, right? And this is a big giveaway for homeowners, right? Everyone agree? This is a major exclusion from income. Okay, but there's another practical side to this. I guarantee if you go around to 100 people who own homes, what might they not know about their house? What thing might they not know? I don't know the value. Pretty close to it.
Oh, how much they spent into it?
Getting to it. They won't probably know their basis, right? Why? Now, you might say, gee, everyone knows, and on the even Zillow will tell you right now what you paid for the house, right? Everyone agree? That's a public record. Agreed? Right. But, as you guys know, Code Section 1016, when you make improvements to property, right, what happens to your basis? So people make additions to their house, right? Their base is supposed to go up. They put a new kitchen in, things like that. But what they're also supposed to do is subtract out the basis of their cost of the old kitchen. But most people don't. Most people don't even know that, right? So because when they buy the house, say for $500,000, they don't know what portion of the purchase price is allocable to the kitchen. And 15 years later, if they put in a new kitchen, they say, well, we'll just add to our basis because we just spent $30,000 on a new kitchen. But they really should subtract out the cost of the old kitchen. But my point is, why is Code Section 121 in the code? One is cultural, right? And two is the practical. Most people will not have a very good command of their tax basis. But it's an expensive exemption, right? And it's not equitable because who lives in rental housing primarily? Less well-to-do, right? Who lives Who's going to be able to avail themselves of the $500,000 exclusion? Wealthier people. So if you're looking at a signature mark of potential inequity, that's section 121. Page 464. Let's look at the problems, and then we'll see an application of code section 121 in the last problem. Recall the Frank case. That's the Morton Frank case, right? The person who sought to buy a newspaper. You recall, and this opened the door to code section 162 and what is carrying on the trade or business, if you recall. What is carrying on a trade or business? And it says, should Frank's expense be deductible under code section 212 or 165 C2? And the answer to that is, remember, when our taxpayer, Frank, sought to find this newspaper, he had not yet begun to produce income, right? And because if you look at code section 212, you can only get a deduction for investment expenses if the enterprise produces income, right? So in this case, it would not have been deductible under code section 212 because there's no production of income, nor would it have been deductible under 165 because to get to 165, you have to enter into a transaction. Well, taxpayer at the stage of investigation had not yet entered into the transaction. Question B, it says, what happens if taxpayer decided to buy the newspaper and incurred capital expenditures to begin operations, but then abandoned his project? Would he have been allowed a deduction? What do you think if you start an enterprise and then the enterprise falls apart?
Sorry. Would that be 165 because he entered into it?
Right. Would it qualify for a 165 loss? Yeah. And if you enter into now, truly enter into a business enterprise, and now the business fails, you can secure a loss.
So for, just so I'm clear, for 212, does that mean income, for income production, does that mean positive income, or could he have lost money too?
You have lost money too, in my opinion.
So what's the major difference?
You just, well, whether you make money or lose money, investments by their nature can make money or lose money.
I'm sorry, between the two code sections.
Well, 212 deals with holding an investment. 165 deals with an actual loss that you incurred on the disposition of the business. Question 1C. Suppose Frank entered into the business and elected to use 195, but ceased operations before deducting all of his startup expenditures. To what extent could he take a 165 loss? So, if you recall, Code Section 195 deals with so-called startup expenses. If the business, and remember that many startup expenses have to be capitalized, right? Under Code Section 195 and amortized over what period? How long? Code Section 197, how long? Again, Maduka? 15 years, right? But Code Section 195B2 permits for an immediate deduction. 195B2 permits for an immediate deduction.
195B2.
Yeah. Allows those startup expenses to be deducted. By the way, I'll mention this now, and I'll mention it Wednesday and probably Monday before I forget. I believe, but I'm not categorically sure, you guys will have to help me on this, that student evaluation should for this class become available soon, but I'm not sure. You didn't get any prompts for this, did you?
I
Yeah, we
got
did.
some kind of prompt. I don't know if it was for this class or
No,
another.
it's for business law.
Business law, yeah.
Right. It should, hopefully beginning on Wednesday. And the reason I call it to your attention, particularly those people on WebEx, if you have any suggestions in particular on WebEx, feel free to mention it there. If you want to talk to me personally, I don't know what I could do differently or better on WebEx. This is I tried it for the first time this summer, so it's not like I'm a seasoned veteran at WebEx. So any suggestions or ideas, guys, those people physically here, those listening to the tape, or those people today, for example, on WebEx, if there's something that you recommend, I invite your critiques and let me know what I could or should be doing differently. All right. Question 2. Homeowners purchase their vacation residence for $180,000, $20,000 allocable to land, which means it's non-depreciable, right? When it's worth $160,000, $20,000 of which was allocable to the land. They moved out and put it up for sale, but not for rent for $170,000. The question is, may they take deductions, the expenses and depreciation on the residence? If so, what kind of expenses would qualify? Put it up for immediate sale.
No,
No, meaning what, James?
they cannot take deductions for expenses and depreciation and income producing.
Yeah, they didn't hold it out. They didn't even try to rent it. If they tried to rent it under the Horman case, they could have probably taken depreciation expenses and maintenance expenses. But here, they didn't. I just query under the Laurie case, which I think is a suspect opinion. Were they holding this for post-listing appreciation? Think about it. The house, when it's worth $160,000, they put it up for they put it up for $170,000. Would that justify the ability to, under the Laurie decision, to take expenses? And the answer, at least my gut instinct, is, hey, they put it up for $170,000. You know, and I know most people put it up for more than they anticipate getting, just as a reality check. Now, I have problems with the Laurie decision that this doesn't. If the fact that they put it up for immediate sale, I think smacks at the fact that.
Will you say immediate sale in the test? Because reading this, I could see it both ways. I mean, if I'm
I
going
can
to
see
court,
both, but this is
I'm
not
gonna
a good
say,
question.
no, I
for
waited
multiple
2 days.
choice.
I waited 2 days. It wasn't an immediate sale.
Yeah, I know. This is not a good multiple choice question, James, in fairness, because this could go either way. I'm just saying to you verbally, it's highly problematic. I think the Laurie decision is highly problematic. This fact pattern the authors are drawing our attention to, I think they're suggesting it's problematic. And they're not trying to make a real profit because they bought the whole thing for $180,000. They're trying to make some money now that they've lost money. At the end of the day, they're going to lose money. Everyone agree? And they can't take a loss here, section right 165, because they originally bought it for personal reasons. In my opinion, they never really converted it to an investment. Right? In a Horman case, you got to do something more than just holding the property. It's truly got to be entered into for profit. I think it's hard to justify this being entered into for profit. Purchase, no. Question B, suppose instead they rented the property and properly took $10,000 depreciation deduction. What result when they subsequently sell the property? For $145,000. Now, what is their tax basis? Now, we need to know the depreciation method, the convention, but we also need to know, right, the basis upon which they're going to depreciate the property. So what would be the starting point depreciation purposes, guys?
180.
Would it be?
Would it be 160 because the 20,000 is
Yeah.
not depreciable?
Would it be one, would it be 160 or something else?
140?
About 150.
140. Right, when they put it into service, right, guys? How much is the building worth?
But for sales, would be 160.
Not when they put it up for sale, but let's suppose they say they rented out the property first. And at the time they rented it out, the value of the building and the land combined was 160. Got to back out the land, so it's 140. Now you need authority because that's how you guys in our world operate. If you look at the authors directed you to this. Look at regulation 167G-1. 167G-1. Very short regulation. The last two sentences. In the case of property which has not been used in a trade or business for help in the production of income, which is thereafter converted to such use, the fair market value on the date of such conversion is less than the adjusted basis at the time, the basis for computing depreciation. But that has to make sense, right? 167G-1. If you don't use the lesser of the two, then you're going to allow people to depreciate property when it was being used for personal consumption. 167G-1. Oh, it's going to be at the end in the regulations, right? Here we use dash.
About 1030.
Okay, 167G-1. If you look at those, a sentence or two, it expounds on that. Okay? So that's the depreciation, but then it's asked, well, what kind of loss sold or gain is subsequently sold for 145? Well, what code section when you hear the word sale, guys? 101, right? Sherman or David? Someone said it. What's the amount realized here? 145, right? What basis do we use? Okay. Why?
Take like 160.
But he sold the building and the land. Right? What's our basis here?
Is it 150?
Okay, why? Look,
You're selling both, so it's 160K.
okay, the answer is the basis is 150. Look at regulation 165-9B2. Look at regulation 165-9B2.
Professor, I'm sorry. So the 167G-1, where the base is $140,000 on the property.
I apologize. 167G-1 just talks about what number you use for depreciation purposes. Well, it does, doesn't it? Now, remember, that's under depreciation. 165 deals with computing gains and losses. 165-9B2. Okay, if everyone has it open, Natalia, that's in the second. Got that? 165-9B2. The second sentence says, for this purpose, the adjusted basis for determining the loss shall be the lesser of. The lesser of. It's going to take the lesser of and the date of conversion, the fair market value on the date of conversion, or the taxpayer's adjusted basis. Lesser of the two. So what ends up happening here is we take the lesser of the two, not the taxpayer's 180, but rather the 160, right? Less the depreciation of 10. The basis here is 150. The loss here is 5. $5,000 loss. They sell it for 175. What's your amount realized? 175, right? What's our basis here, guys? What do you say, 150? being sold for a gain or loss here? So for a gain, right?
Professor, can you just explain why we're using 160, finding the base as opposed to 100? But the
Because
base is
if you look at
not paid
regulation
for.
165-9, D2, says the second sentence, just the basis for determining loss shall be the lesser of the following amounts. Right, James? And we're given a choice. The fair market value at the time of conversion, and the fair market value is 160, or the adjusted basis at the time of, the adjusted basis for determined under quotation 1011, but without reference to the fair market value, which would be the 180. Use the lesser of the two, which is 160 less 10. But that's for purposes of determining a loss. How about it for purposes of determining a gain? Don't we just use our normal depreciation rules? What would it be our basis here, guys?
170.
170, right? Now we can use the 180, right? Minus 10 of depreciation. And here's 5. And of course, James, you would tell us the character of that 5,000 is what? They called on you for a reason.
1231.
Oh, no, because 1245 or 1250, one of those involved here.
Which is it?
1250. Gain from disposition of certain.
Hey, James, didn't you start off class with the peanut butter and jelly?
Start off high.
Justin, you're killing me. But do you see how quickly it can fall apart? Don't remember your peanut butter and jelly sections here, guys? Folks on WebEx, hopefully you would have gotten it, right? Easy to say you would have. Right? 5,000 of unrecaptured 1250 gain, right? Suppose you sell it for 165. Sound familiar? Sell it for 165. Thank you, Shervon. Say it loudly. What's your authority? Regulation 1015-182, example 1. Right? You guys remember that from several weeks ago? Regulation 1015-182, right? That's in the gift context, right, Shervon? But very similar to what we're doing here. There's one basis for determining loss. There's another basis for determining gain. Because of that, there's no gain or loss. Remember that?
On it, aren't we? We're giving this as a gift.
We're giving it, we're selling it, but those principles of explaining that you have one basis for gain purposes and another basis for loss purposes, and it's right in between the two, just that in this context as well, there would be no gain or loss. Look at the example in the regulations, the person who had received the gift is subsequently selling the gifted property. Reread, and you'll see, even though it's a slightly different context, that regulation is apropos for here. Question C says, what resulted in B2 if the property had been the homeowner's principal residence and they owned it and used it 4 out of the 5 prior years? And the only thing the authors are trying to call to your attention is under Code Section 121D6. Code Section 121 is the exclusion section. 121D6 essentially says, hey, if you took depreciation deductions and you subsequently sell property, you have to include the prior depreciation deductions in income. So the answer here is under Code Section 121D6, any prior depreciation deductions up to that amount will be 1250 unrecaptured income. By way of simple example, if you own a house and you depreciate a home office, just make this up, right? And you take $100,000 of depreciation deduction. subsequently sell the property for 500, same price you bought for it, that $100,000 you can't exclude under Code Section 121. That's going to come back into the taxpayer's income. Okay. Questions? Folks on WebEx, something's flashing here. I don't know if you have a question or not. Sorry to backtrack, but to clarify, question 2A is referencing a personal expenses in Code Section 262. Okay. Well, you know, if the property in question 2A, those are personal expenses. Yes, I'll share that. Section 262. Okay, personal, if they don't qualify here, they're going to be non-deductible personal expenses. Okay. All right, let's finish up the chapter here. And final question. Single purchases a principal residence after 2008 for a cost of $200. Prior to occupying it, single rents it out for 1 year, taking $10,000 depreciation deductions. Single then occupies it as a principal residence after owning it for 5 years and sells it for $400,000. Okay? So the first year he rents it, and the other 4 years lives it as a personal residence. What are the tax consequences to single? So we hear the word sale. You guys think what code section? Don't want to like the way you think. And what's the amount realized here?
400,000.
400, right? And what's his basis? Isn't it 190?
I said 190.
Again, loudly,
I
David?
said 190.
Why?
Depreciation.
For $10,000 depreciation, so his basis has to be 190. His gain here is 210, right? What's the no. Things are going to go on here. What I call your attention, our authors make mention is Code Section 121B5. You want to open up to Code Section 121B5. Okay, it says Code Section 121A shall not apply to so much of the gain from the sale or exchange of property that is allocable periods of non-qualified use. Okay? And basically, what is non-qualified use? Look at 5 capital letter C. Period of non-qualified use means any period during which the property is not used as a principal residence of the taxpayer. How many years was the taxpayer not? 1 out of 5. So the gain allocable to that, which is 1/5 of the gain. How much total gain was there, guys, here? There's $200,000 of gain. Everyone agree? So of this, there's 200. Right? Did this property appreciate by 200,000?
What do you have up there, Professor?
I have,
You have 210 as the gain up there.
but the 210 is the total gain, but the appreciation during the 5-year period went from 200 to 400, right? So of this, $10,000 is unrecaptured 1250 gain, right? And under Code Section 121B5, take 200 times 1/5, right? That's the non-qualified use. The 200 is the appreciation during the total ownership. 40,000. $40,000 of the 210 gain is going to be just treated as normal long-term capital gain. And then, what about the remaining 160? Because we have 40, we have 10. So we have how much left? 160,000. And what's going to happen to that? It's excluded under Code Section 121A. So Congress says, look, you got to recapture any prior depreciation. If you had non-qualified use of that property, that's going to be not excluded under 121. And the balance you can exclude under 121. Okay. How about if we sell the residence for $600,000? Suppose we sell the residence for $600,000. Gain or loss? The amount realized? Basis of 190, gain of 410, right? Okay. Figure out what the taxpayer must report in income, this single taxpayer. Take 1 minute. On WebEx, tell us what the taxpayer will end up reporting. You're ready.
80,000 long-term capital gain.
Why? Is that the total? Total amount the taxpayer has to recognize. James?
Oh, he's 90K?
I have 70.
70. 90?
If you include the unrecaptured gain.
Oh, 80.
80? Any other numbers? WebEx people, anyone going to chime in?
Hold on. Unrecaptured gain is not long-term capital gain.
Tax at a special rate, it's 25%.
Like,
We're going to pull out the 10,000, right?
yeah, but then you put it back into ordinary income at the bottom.
Why would it put it back in? Go ahead and recapture.
And then you lose it, and then it's out of the equation when you take it out.
James?
I'm sticking with $70,000 long-term capital gain.
But bear in mind, we have non-qualified use, right?
Yeah, I'm not sure what you mean by that, so I need the answer to like think about if I'm right.
The
or wrong.
non-qualified use is 1 out of the 5 years was not being used, right, as a personal residence, so it's non-qualified. And what was the appreciation of this property in the taxpayer's hands? They bought it for how much?
100,000.
And how much is it worth now? How much did it appreciate?
400,000.
So we take the 400 appreciation times under 121, and the gain here is 80, right? And that's not excluded, right? The 80,000 long-term capital gain. But how much gain is left, guys? Well, 320 is not excluded. What's the cap? Maximum you can exclude, 250, right, for a single taxpayer.
That's what I got.
So it's another 70,000 of long-term capital gain. So you have to recognize 10,000, 80,000, and 70,000.
Recognize it though because it was in the first year. Wouldn't it be a short?
What, is this the 5th year? When they sell the property?
But you kind of like it lost its designation as. Stopped using it for the production of income after year
Well,
one.
they never produce income here, really. I mean, they got, at some point, they rented it for 1 out of 5 years. So I'm not sure what your question is.
My head's just that they kind of changed the character of the asset, right? Because it went from income.
Yeah, but remember, this is a capital asset. Everyone agree? A home is a capital asset. So only this portion is going to be the unrecaptured 1250 gain. Everything else is long-term capital gain.
Total is 160 is,
Yeah.
gotcha.
You have to ultimately report 160. You can't exclude the entire 320, right, guys? Section 121 only permits the first 250,000. C says, where the tax consequences day above a single initially occupied the residence for 4 years and rented it out the 5th year. Is that considered that 5th year? Does that create non-qualified use? And the authors really want to direct your attention. Take a look at code section 121B5. That's where we were before. Capital letter C, 2 little I, Roman numeral 1. How's that? I'll repeat. 121B5C, 2 little I, Roman numeral 1. 2 little I is entitled exceptions. Says the period of non-qualified use does not include any portion of the 5-year period described in subsection A, which is after the last date that such property is used as the principal residence of the taxpayer or the taxpayer's spouse. So this does not qualify as how do I say this? This will not create a non-qualified time period. So all 5 years would be qualified here, guys. Okay? Your answer would simply be 10,000 are recaptured. Everything else would be excluded.
All else excluded, even if you sold it for 600,000?
Oh, no, question A is
Oh,
where
you
you
sold it for.
400,000. Right, if it was sold for 600,000, different issue. Only the first 250 would be excluded. Right, so you guys read this a fond adieu to chapter 15 and move on to chapter 19. Fundamental timing issues. Any questions on final questions, chapter 15? WebEx people, any questions? Right there? Okay, so chapter 19, guys, we begin a journey. If you recall from chapter 12, we looked at the issue of who, right, is taxed on income, and we said that's important because of people having different tax rates and possible limitations. Chapter 19, entirely different exercise, looks at the issue of when, right? When is something going to be includable in income or deductible, okay? Keep in mind, we're going to look at two important issues. And in your mind, make sure for exam purposes, questions I ask, does it pertain to income inclusion or deduction, right? For our purposes, the authors first point out that there are several different methods. Look at this, including cash, accrual, installment method. There's a fair amount of variation. But for our purposes, really just hone in on the cash method and the accrual method, okay? So bear that in mind. That's what we're going to use. And as I pointed out to people, this chapter can really be thought of in 4 different quadrants. The first half deals with the cash method. The second half deals with the accrual method. The first part deals with inclusion issues, with deduction issues, inclusion issues. Second part deals with deduction issues. Right? Very different code sections at play for each. Okay? So you might want to begin by just turning to code section 441. Section 441, if you look above, the first thing it talks about is accounting periods and methods of accounting. In subchapter E of the Internal Revenue Code. Counting periods, generally, going to be a calendar year, but some taxpayers are allowed fiscal years. Fiscal year is any year other than a calendar year. Okay. Sometimes Code Section 443, for a host of reasons, you may have a return for shorter than 12 months. I'll let your attention. On Code Section 446 points out taxable income shall be computed under the method of accounting on the basis of which the taxpayer regularly computes his income, keeping his books. However you keep your books for GAAP purposes is generally how you keep it for tax purposes. The code does put restrictions under Code Section 448 on the cash method, right? Restrictions on the ability of taxpayers to use cash method. They can't just use that at their liberty, at their whim. Beginning on, look at Code Section 451. Discussion of inclusion issues. Okay, so Code Section 451 begins a discussion of inclusion issues. So add this to your repertoire. Code Section 451, inclusion issues. And just point out to you that Code Section 453 deals with the installment method, or periodically asking me questions, where do you get the installment method from? There you go. And then, for our purposes, look at Code Section 461. 461 is an important one because it deals with year that deductions are permitted. So, in terms of important code sections, in particular for our purposes, Code Section 451 and Code Section 461 are key code sections that you're going to have to add to your list of code sections. So for the exam and for the CPA exam as well.
Professor, can you just summarize 441 again for us, please?
441 just talks in general about that you need, in general, you use a 12-month period. You have a calendar period, or it could be a fiscal period, something other than a calendar period. These general rules, and you guys have been through this process on many occasions. Once you get the general rules, we're going to talk hopefully about the exceptions. And for cash method, guys, you would think, gee, that's the easiest thing in the world. Taxpayers get some greenbacks. And if they do, taxable, right? By the way, in this world of cryptocurrency and the like, is cryptocurrency, guys, Bitcoins, did I say it wrong?
No, you said it
No,
right.
you're right.
Yeah.
We say Ethereum, but sometimes we call it like Ether, like 1 Ether, 2 Ether.
Right. Have you used
Contract.
Bitcoins, Jiyoung? Does anyone here use Bitcoins?
Hold some, but they're treated as a capital asset, aren't they? Not a currency.
They're not treated as currency. So you risk anytime you use them, have Code Section 1001 apply. And if you use them to pay obligation into, if you recall the Keenan case, right? Use appreciated property to satisfy some sort of obligation, gives rise to gain and losses. That's not going to be on your exam. Let's keep it to basics. Just want to say that the world is changing, right, guys? Things that you have to consider. All right, so the cash receipts and disbursements method. So let's just start. So the authors just give us a few pages of introduction. Let you guys read that at your leisure. Beginning on page 591. Here's a discussion of the cash method and disbursements method. We have the collar case, getting on page 592. Again, you would think there's this easy, straightforward way of addressing this. This would be it. I suspect many of you didn't get this far, got this exam coming up, but putting that issue aside, here's the taxpayer receiving a check written to him, and it's on December 31st. The banks are closed, and the question is, does he have taxable income in 1946 when he receives the check, or in 1947 when he deposits the check? The answer is, even if you didn't read the case, get a check on December 31st, and I'll call it after hours. And why would the taxpayer care, guys? Why would a taxpayer care? 1946 versus 47? Who cares? Why would you care? Well, tax rates could be different. Presumably the tax rates were, I'm going to assume for the moment, lower in 1947. Also time value of money, right? You get 1 year of deferral. You can report in 1947 versus 46. So taxpayers generally, as I pointed out last class, going to look to try to defer. The IRS, by contrast, is going to look to accelerate, right? Who wins here if you were a judge? 1946 or 1947? Natalia, what do you think? What year would you tax the taxpayer and why? Why would you say 46? If it's stick it to the taxpayer? Your rationale, James?
Well, I never want to stick it to the taxpayer, but here it gives us the definition of a negotiable. As a conditional payment subject. Honored upon presentation.
Right?
So if he got it, it's got to be income.
And the taxpayer loses here. IRS prevails. Why? Even though this is not cash, guys, this is a cash equivalent. Okay? Even though it's not cash, equivalent of receiving cash. Even though the banks were closed, theoretically, he could have gone to some other resource and got in cash. Because it was a negotiable instrument, and as such, it was the equivalent of cash. Okay? In Williams v. Commissioner, 594. Here, the taxpayer receives a note, not a check. Taxpayer receives a note, $7,200, payable 240 days later. So he receives the note in 1951, but is not paid until 1952. What year? Taxpayer be taxed. Does this court hold? What do you think? Now, this guy tried to sell the note on several occasions before it became due and payable, and no one wanted to buy it from him. He had to wait to collect it. Apparently tried to sell it between 10 to 15 different times. When you say that he was being paid for, I believe, services, but it was just in the form of a note. And here, the taxpayer prevails. It's not taxable in the year he receives it. Why? If you look on page 595, the fourth full paragraph. Page 595, 4 paragraphs down. Petitioners contend the note in question was not received by Williams as payment, but merely as an evidence of indebtedness. So if James provided services to me, I said, hey, James, here's an IOU. I owe you $7,200. I'm not giving him a check. I'm just saying, here, I'm going to put this down that I owe you this money. I can't pay you for a year, but here, you have this evidence that I owe you the money. Is that considered payment? And the answer is no. So mere evidence of indebtedness does not constitute payment, right?
Are we differentiating payment from income?
Well, payment, in this case, taxpayer doesn't have to include it in income. Can I answer your question? Where in the Collar case, they had to include it in income. Payment was considered includable in income. Does anyone in WebEx have a question? Sometimes I just see that go off. Oh, I appreciate you listening. Right? Got that? David Sherban, you got it? Okay, Cowden. Cowden, this case is kind of strange because they got these royalty payments, and we know, right, that with respect to royalty payments, how are royalty payments typically taxed? As ordinary income. Everyone agree? If you're going to get a series of royalty payments, generally it's going to be taxable as ordinary income. And they're going to be given instruments that say later amounts are due, okay? You're going to get instruments for about $500,000, and given the years involved, this is serious money. That says that the money isn't due for 1 year later, and in the case of the second instrument, 2 years later. Okay, so picture, if you will, taxpayer is going to be paid these royalty payments, and they're going to be given notes saying that they're due no more. One payment is due a year later, second payment is due 2 years later. The question is, when should they be taxed? When they receive these notes, or alternatively, when the notes come due in owing? And just so you know, these taxpayers were very aggressive. How do I know that? Because at the bottom of page 596, they reported this income not all in the first year. They reported as the notes became due, but they reported them as capital gains. Okay, they took the position that that the receipt of this royalty payment constituted capital gains. So I know that these are pretty aggressive taxpayers. The IRS takes the position that these notes are all taxable in 1951 when the taxpayer receives the notes. And the tax court holds in favor of the IRS. So this is on appeal to the Fifth Circuit. And the taxpayer's big argument is that this is not a cash equivalent. Why is this not a cash equivalent? This gets back to your business law class. James, I think you mentioned this before when you were referring to what did the taxpayers, you may not have read the case, but on what position, and anyone else who took, you all took business law, what position would the taxpayer potentially say that it's not taxable? And they said it's not a negotiable instrument. Not negotiable on the face of it. Your business law class, that makes it harder, right, to negotiate the instrument and get cash. But what was clear is that even though it was not negotiable, it was assignable, okay? Let me repeat that. It was not negotiable, but the note itself was assignable. Okay, now look at the paragraph on page 599. The second full paragraph. A promissory note, negotiable in form, is not necessarily the equivalent of cash. Okay, so not all negotiable notes assume that they're a cash equivalent. Such an instrument may have been issued by a maker of doubtful solvency, or for other reasons, such paper might be denied ready acceptance in the marketplace. So Usually a negotiable note is a cash equivalent, but not always. Okay, everyone agree? Then the authors of this opinion go on to say, we think the converse of this principle also ought to be applicable. We are convinced that if the promise to pay of a solvent obligor is unconditional and assignable, not subject to any set-offs, and is the kind that is frequently transferred to lenders or investors at a discount, not substantially greater than generally prevailing premium for the use of such money, such promise is the equivalent of cash and taxable in like manner as cash would have been taxable had it been received by the taxpayer rather than the obligation. So in other words, let me translate that. It's saying, hey, even if this is not negotiable, but it's assignable, this could be a cash equivalent. And as such, it would be taxable immediately. And that's the taxpayers lose just based on that, because it was evident that the receipt of this note, not negotiable, but it was assignable, and as such, it would or should be considered a cash equivalent. Yes.
What happens in real life, like, so just for instance, these guys are musicians, don't have the funds to pay the taxes on both notes.
If these were what?
For whatever reason, they can't pay the taxes.
And they have to go out and borrow it.
Can't just not pay it.
Not pay, but you should file a return, and then filing a return is a big problem, okay?
Filing what?
Not filing a return is problematic because the penalties are significant. It's 5% per month for every month you're late for filing a return up to 25%.
Definitely do that. But
You've got to file a return. If you don't pay, it's 0.5% per month plus interest penalty. Right? You've got to file a return. And you got to advise the client that there's penalties for failing to pay. The notion is if you come into a lot of money, even if you're not liquid, you can always go to a bank and borrow against a bridge loan. Any football fans out there, whether it be on WebEx or here? Football fans out there? Hey, you're saying yes.
Big time, yeah.
All right. Do you know owning? Look on page 600.
Nope, do not. Can't say I do.
Right.
Before
Paul
my
was a
time.
big football superstar. Okay. And he, just to make everyone's life interesting, he received as part of victory on the field a 1962 Corvette, December 31st. Okay? When I say received, he was told that he had won because of his performance on the field. The question is, should he be taxed in the year he receives it, or should he be taxed the next year? And how did he originally report this, guys?
oh yeah.
He reported on page 603. He took the position it was a gift. So I know when you're making, and I say tongue in cheek, I know when you're doing extraordinarily well as a football player, your heart goes out to him for not reporting it. But this was aggressive again, because was this a gift, guys?
No.
No, it's an award. We know Code Section 61 taxes it if you need affirmation of that. Code Section 74 would say this is taxable, right? So this taxpayer we know is over the top, right? It has not reported. Now, how do you think this case comes out? Should it be taxed in the year December 31st when he won it? Or should he, the taxpayer, by the way, the IRS is reversing roles. The IRS is saying it should be taxed in year 2. The taxpayer is saying year 1. You might say to yourself, why? Why would the taxpayer say year 1 and the IRS year 2?
Maybe he doesn't have enough income.
Remember, this is several years later. So why he's arguing year won, when he won the prize, is because he's saying that the statute of limitations after 3 years lapses. That's Code Section 6501. So the IRS is saying, no, he really didn't get it until year 2. So it's a role reversal.
Oh.
Statute of limitations would have been.
If it's reported in the second year, it would not have lapsed. If it was reported in the first year, the IRS is out of luck.
Oh, why? Because when they were pursuing the.
Yeah, this is years later.
Got it. Our lawyer.
Invoke what you can. So here, the taxpayer is saying, hey, I may have misreported it, but too late. Wins and why? Now, the taxpayer says, look, if you open up your regulations to Regulation 451-2, take a look at 451-2. Because remember, the taxpayer, you guys didn't read the case yet, he's playing, I forget where he's playing, in Green Bay. The car is actually in New York, okay? Hundreds of miles away from the taxpayer when he learned that he won the award, okay? He could not have physically gotten in the car, but he says, under Regulation 451-2, he had constructive receipt. Constructive receipt says what? Under the general income, though not actually reduced to a taxpayer's possession, is constructively received by him in the taxable year during which it is credited to his account, set apart for him, otherwise made available so that he could draw upon it at any time, or so that he could have drawn upon it during the taxable year if notice of intention to withdraw had been given.
Are you saying you could have taken a plane that night to go pick up the car
Well,
if you wanted to?
could he have? And the answer is probably not, because, hey, you know, to get through airport security, get to the airport, get to security, just use your imagination, given the years involved here, probably could not have got into the air. So he's saying he had constructive receipt of the car because it was set aside for him. Now, keep in mind, the judge here, who's probably making 1/10 of what the football player is making. You know, if you're a human being, do you think you're going to be too sympathetic here, Mr. Honing, or whatever you pronounce his name? Probably not, right? Everyone agree? Human nature. Maybe you guys think I'm shallow by saying that, but probably not going to be too sympathetic here to the football player. And ultimately, rules against the taxpayer and said you could not have gotten this car. It was out of your reach. Therefore, it should be taxable in year 2. Statute of limitations has not lapsed. I will tell you somewhat, at least in my funny story, but you may not find it funny. That's okay. That 6 months ago, I'm reading my sports section of the newspaper, which I don't read too often. I think it was. And I see a big article about who? Paul Horan. You might say, hold on, look at the years this case. Why would I be reading a case about him or reading anything about him in the sports section? If you want to Google this, you may be entertained, particularly you, David, if you're a big football fan. Suing the helmet manufacturer because he's, you know, a lot of football players are claiming that they've got early onset of dementia and other things. So he's claiming that he was not adequately protected by his helmet. He and others, but he's apparently at the helm, no pun intended, of this lawsuit against the manufacturers of football helmets. So if you want to read a current case about our taxpayer, even though this case is 50 years old, I think he's in his 70s or 80s, you may find it interesting. All right? Google his name because, like I said, I was reading this and all of a sudden I connected the dots. All right. Let's talk on page 605 about deductions, okay? That says 54-465. that if you make a charitable contribution, it's usually when you make the charitable contribution that you get a deduction. When you make charitable, but let's face it, a lot of people make charitable contributions at the very end of the year, December 30th, 31st. That's when the check is dated. And the charity does not deposit this check until, say, January 10th. The taxpayer who makes, say, a $100,000 contribution to charity, when should they get the deduction, year one or year two? What does this revenue ruling say? Year one, that they're going to treat the check as the equivalent of cash. How about when you use your credit card? How about when you use your credit card? When should you get the deduction? Remember, when you use your credit card, when do you often pay? Credit card in December? Pay in January. Hopefully you pay in January. And there's a revenue ruling, 78-38, that says that's when you get your deduction. You get your deduction in December. In other words, a lot of people, right, they use their credit cards and use in lieu of cash, and the code wants to be 21st century, right?
So to clarify, the deductions come when you make the payment. No, when you like purchase the goods.
When you make the purchase. So let me just talk to you for 5 minutes and just to give you a heads up on what we're doing, because again, without you guys having read these cases, I'm not sure how much you can absorb. So just stick with me for another 3-4 minutes. So now you get the income side of this chart. Okay. What we're going to do is we are going to look at the deduction side and fill in the exceptions. That's going to be part of our agenda for next class. And then we're going to look at, just so you see, and I'm just going to share with you, beginning on page 617, there is a set of problems. And just so you know, to organize yourself, and there's going to be a fair number of questions on the final exam with cash versus accrual, income versus deduction. There is a question, I'm just giving you, and it talks about a lender, and it talks about a debtor, okay, on page 617. And what I try to do with all these, even in my notes, if you look at my book, I'll share with you, is I always label who has the inclusion issue, who has the deduction issue. So my recommendation is make sure you label when it comes to the exam. Is the person dealing with an inclusion issue or a deduction issue? So when you go through the answers on problem 1, A, B, C, whatever, we're going to look at the income and inclusion side, and that's going to carry through on question 2. Right? And then notice, beginning on page 618, so first part of class, we'll finish up deductions, go through the problems, and then we will launch into the accrual method, beginning on page 18. Notice, once again, it follows the same pattern the first half. It starts off on page 618 with income items, okay? And then we're going to flip through, and page 634 starts deduction items. And under page 634, the big code section, keep in mind it's code section 461H. 461H. And the big test for whether or not something is deductible, guys, something called the economic effect test. The economic effect test. we're going to go through there. And on page 645, there's another series of problems, and we're going to follow the same pattern we did with cash method, which is look at the income and inclusion side. We will probably just finish there, and then if everything falls into place on Monday, we will finish up the chapter. There's only going to be 3 more pages left, but there's a series of questions that sort of ask questions that hopefully will serve as a refresher for chapter 19 because it deals with both the cash and accrual method. Right? So hopefully I will see those on WebEx. I will see those who are here on Wednesday. Good